I'm about to show you how you can save thousands on taxes in retirement using one simple strategy. This is something that most retirees either overlook or simply don't know about, and it's called asset location. Now, it's not to be confused with asset allocation. So, by the end of this video, you're going to understand what asset location is, the benefits of it, and then how you can use it in your own portfolio. So, to explain this as best as possible, I wanted to put together an example and walk through this with you. So, right here on your screen, you can see asset location, and this is an example of what is being done wrong. So I want to walk through some of the assumptions here, and then I want to show you how you can do this correctly. So we've got three different account types. We've got a tax-deferred account type, we have a taxable, and then we have a tax-free. So think of this one here as like your tax-deferred IRAs, your 401ks, your 403b, anything that has not been taxed yet. This is either an individual account, a brokerage account, or a trust account. And then this is going to be your Roth IRAs, Roth 401ks, and so forth. So you got three different account types, and this is making obviously a few assumptions. We're assuming that we have the same amount of money in each one. I want to keep the math as simple as possible as we go through this, but that's what we're assuming there. And we're saying that overall, this $1.5 million in this portfolio is going to be invested 60% stock and then 40% bond. And so over here to the left, you can see the different rates of return or interest rates or dividend rates associated with those different positions. So we've got a 7% annualized stock return that we're going to assume here. We're also going to assume a 1% dividend on those stocks, and then a bond or fixed income interest of about 4% with no underlying asset appreciation or growth. So obviously, this is making a lot of assumptions, but I want to use the basic examples here to explain this to you. So with that understanding, we've got $1.5 million, 60% of it is in stock at this point, and that's evenly spread across all three accounts. So 60% is here in the tax deferred, 60% in the taxable, and then also 60% in the Roth. The other 40% is obviously the bonds in each of those different accounts. And this is an example of doing it wrong, and here's why. The one thing we know about a tax deferred account or a traditional IRA or traditional 401k is that anytime we take money out of that, it will be taxed as normal income. So that's the first thing we know. The next thing we know is anytime we take money from a Roth IRA, which is a tax-free account, after the account has been open for 5 years and you're at least 59 and a half, every single dollar is tax and penalty free to you at that point. Your contributions, on the other hand, those are always available to you without tax or penalty because that's money you've paid tax on and you've put that into the account. You don't have to wait 5 years to take that money back out, nor do you have to be 59 and a half to take that money back out. Now, the taxable account, that's the one that creates a little bit of confusion here in the middle. This is going to be an individual brokerage or a joint brokerage or perhaps a trust account. The reason it's called taxable maybe is because every single year you're going to pay taxes on any dividends, interests, capital gains that are realized in the account. Anytime you sell or new money comes into the account from interest or dividends, you are going to have some sort of capital gain or a capital loss at play there that you could either use as deductions on your income or you could have capital gains to pay taxes on. So it's taxable every single year. Obviously, your unrealized gains are not taxable every year so long as you're holding that investment. Now, within that taxable account type, you've got different types of taxes you could pay. You could pay ordinary income taxes or non-qualified dividend taxes or tax on interest, which is going to be a normal income tax rate, or you can have a long-term capital gain or qualified dividends, which would receive more favorable tax treatment. And if you look here on screen, you can see what that might look like in the breakdown of that. Your long-term capital gain rate is either 0, 15, or 20%, and it depends on the overall income range on your taxable income that you could be paying that at. So I've done videos previously on how to do tax gain harvesting and what that is and how it works. If you want to go check those out, you can watch that down by clicking on that link down there in the description. But that's the basics of how these different account types are taxed. And just so you know, none of these accounts are necessarily better or worse than another. They just simply are taxed differently. So whenever we think about this, we want to make sure that how the account is taxed and the underlying investments within those accounts are aligned as best as possible. So that's where asset location comes into play here. So we're going to walk through this example to see what can be done in this situation to help improve things from an asset location standpoint, which is going to reduce their taxes annually, but potentially reduce their taxes throughout the rest of their life in future years as well. Right now, let's assume that let's focus on this taxable account, okay? So whenever we have stock of 1% dividend on 60% of 500,000, that's how much is allocated there. That's going to be $300,000. And there's a stock dividend of 1%. Okay, so that's $3,000 that's going to be made there on the dividends just in that 1 year. And now the bond portion, the 40%, that's $200,000 as a portion of the account. And so if we think about that, that's 4% on that $200,000. That's going to be $8,000 of normal interest, or it's a short-term capital gain. However you want to look at that, it's taxed as normal income. So we have these two sources. That's $11,000 that's coming into the account. Of that 11, though, 8 is going to be taxed at your normal income tax rate, and the other 3,000 is going to be taxed at a long-term capital gain rate. Now, what I want to do as an assumption here is I want to assume that we are in the 22% bracket for normal income. Okay, so that's the marginal rate that this hypothetical person is at. So what we're going to say is that means, this $8,000 right here, that is going to be taxed at 22%. Now, whenever we look at the chart here on screen, whenever we're thinking about this, again, whenever you have a certain amount of income, your long-term capital gains can be taxed at either 0, 15, or 20%. Since we are above that threshold for the 15% mark, that means that this 3,000 right here is going to be taxed at 15%. Obviously, this is a hypothetical example. We're assuming the income that he currently has, and this hypothetical is going to be higher than the 0% opportunity there, the long-term capital gain rate. So we know that 15% is what we're going to pay on this $3,000. We know that 22% is what we're going to pay on that $8,000. So what we do there is I'm going to do some quick math. That means $450 is what the tax will be on this portion over here. And then $1,760 is the portion that's going to be the actual taxes to be paid over here on this side. So when we add those two together, we get a total of $2,210. That's the total amount of taxes that are going to be paid on that $11,000 of dividends and interest into the brokerage account. So technically, the after-tax benefit of the dividends and interest is the $11,000 minus the $2,210. That minus that, that's what your net benefit is after taxes. Now, whenever we look over at the Roth, here's a couple things that might be different from that taxable account. Whenever we look at this, we're still going to get the same amount of $11,000 of dividends and interest into the Roth IRA, but we're not going to pay taxes on that because Roth IRAs, just like traditional IRAs, are tax sheltered from a year-to-year basis. There's no taxes to be paid on dividends and interest, which is a plus in terms of compounding that account over time. So we've got $11,000 of growth in the account from dividends and interest alone. Now, when we factor in that 7% investment growth on the 60% of stock, again, is going to be $300,000 out of the $500,000 in the account. We know that that is going to be $21,000 that's going to be increasing the account balance. And we're going to use some simple interest here, okay, just to make things really simple. I know that things compound over time, so next year it would be your compounding would be at a higher rate, hypothetically. But what this does is this plus this, that equals, so your growth from the stock and then obviously your dividends and interest, that equals $32,000 of growth in year one. Now we would add this amount back to there. So 532 is your new balance, hypothetically. And so you'd, again, go from there, compounding at that point. Now, what we're going to do is we're going to look at this from the tax-deferred side. So again, no taxes are paid here on the Roth, but there's also no taxes to be paid here on any dividends or growth in the traditional IRA or the tax-deferred accounts because we're assuming no distributions are being made and you only pay taxes on that account type specifically whenever you make a distribution. So all the gains, any growth that's happening in the account, that is all going to be taxed only at a point of distribution. So again, $532,000. That is how much is going to be in the tax-deferred IRA after 1 year, assuming that 7% stock rate, and then also the dividend rate of 1% plus 4% on bonds. Okay, so the total taxes in this scenario is going to be $2,210 in year one, and we had a total of about $72,790 of growth. So that's the total amount of growth after 1 year at these particular rates. Now, I want to show you what happens if we do this maybe the right way. So again, we've got to think about the different account types and how they're taxed. Okay, so that's example number one, a 60-40 portfolio evenly split across every account. Now, let's look at this from a different perspective. Let's look at asset location done the correct way, all right? So in this scenario, you can see the main thing that's different here is going to be the fact that we have different allocations in each account type. So what you notice is that within the tax-deferred account, we have 100% of that account is in bonds, okay? No money is in stock in this scenario. You've got 80% of your brokerage or your taxable account in the stock side. You got 20% in bonds, and then 100% is going to be in the Roth towards stock. So in this scenario, what this is doing, this is asset location done correctly. We're aligning the investment type with the taxability of each account to make it more optimized for you. Here's why. Whenever we think about a Roth IRA, what we've got is tax-free potential in terms of growth within that account. So we want that account to grow as much as possible. We don't want that one to sit stagnant in cash or bonds or low growth assets. We want that one to be as optimized for growth as possible, at which point we'd want to make sure that, hey, we've got 100% stock in that account if we can. Now, within the brokerage account or the taxable account here, again, because of how dividends, whether they're qualified or not, or long-term capital gains, whether or not that is the opportunity you have in the account, we want to make sure that we are optimizing that as well so that we pay less taxes every single year. So in this scenario, we can't quite get to 100% stock or equity in this brokerage account. And to be fair, most of the time you're not going to be able to, because you might have to pull from a brokerage account, from a money market, or some sort of fixed income asset there to create income for yourself in retirement. I totally understand that. But as much as possible, we want to make sure that we have the higher growth assets or qualified dividend type assets in that brokerage account to lower your tax bill every single year. And then on top of that, we have this tax-deferred IRA over here. We want that one in some sense to grow as little as possible compared to the other accounts. Because if you think about it this way, every time you pull money out of that traditional IRA, you're going to pay normal income taxes anyway. So you want all your interest to be taxed as normal income in that account if it was outside of that account. So you want to align the investment type and the dividends or interest that it does spit off with the taxability of the account. In addition to that, if we think about some of the issues that many retirees face around taxes, one of those could be large RMDs in the future. Okay, so one way to limit or reduce those RMDs is going to be to grow your tax-deferred money less, meaning you're not growing a larger tax bill for yourself in the future. So we're trying to, in some sense, curb or reduce the amount of growth we have in that tax-deferred IRA. So this is asset location done correctly, but let's play this out with some math to show you how you can save on taxes every year by doing this. So again, we're going to assume let's write that down, the 7% stock growth, a 1% dividend, if we go back and remember what we're doing there, and then we have 4% interest on the bonds, okay? So if we assume that here again, let's start with the taxable brokerage account, all right? So 500,000, they're all starting at year one, 500,000 each account. 80% of 500 is $400,000. If we assume a 1% dividend on that, that is going to be $4,000. And then 20% is $100,000. Whenever we have the interest on that, now we have only $4,000 of interest on that amount. So now instead of 3 and 8, it is 4 and 4. So just a little bit less overall in terms of income coming into the account from dividends and interest. And it's also going to reduce our taxes. So let's take a look at that. This 4,000, we're going to assume, obviously, that is a qualified dividend. So that receives either the 0, the 15, and the 20% rate. We're going to assume they're in the same tax bracket. So 15% on that amount. And then we're going to assume 22% on that amount. And if we do some quick math here, that equals $600 of tax on the 4,000. And then on the interest side of things, that's going to be $880 total taxes. And when we add that up, that equals $1,480 of taxes to be paid on that $8,000 of dividends and interest that came into the brokerage account. So that's part of this. And if we look back really quickly, we can see that $1,480 is different from the $2,210 by $730. So it is $730 of actual taxes being paid less to just change the allocation here. If you stack that over, a 10-year period, that's $7,000 plus dollars that you could be saving in taxes over that 10-year period. Obviously, this is looking at this on a small scale, and it might be a big difference between how your portfolio is currently invested and what you could do to optimize it. But this is an example, a simple example of how you can save more money on taxes year to year by doing this one simple step. Now, what's even more, I think, important here is going to be the fact that now we have larger built-in gains in all of these different accounts that are invested differently. So again, 80% of our brokerage account now is in stock, which again is getting a 7% annualized return. So we take that and multiply 7% times $400,000. That's now $28,000 of additional growth that's been deferred because it's not been sold. Those gains haven't been realized, but $28,000 is now what we have in the account from stock growth, plus whatever the dividends minus the taxes would be, which is going to be $34,520. So $34,520, that's the new growth amount in this taxable account. And that's comparing it to the growth from the 60/40 portfolio that we started with of about $21,000 here on the stock side, plus the dividends and interest minus taxes, which was about 29,790. So 29,790 is what that taxable account grew by in a 60/40 portfolio. Now it's growing by 34,520, which is about a $5,000 difference there in either built-in or deferred capital gains, but also there's lower taxes to be paid. So you made more money in the account and you paid less taxes to do it that way. Now let's focus on this Roth here for a second. So let's assume this. Let's assume that the Roth is 100% stock instead of 60/40, which is the most optimal way to do this. So if we take the $500,000, we multiply that by 7%, that equals $35,000 of growth. And we have to remember to also add in that 1% of dividends. Okay, so that's another $5,000 of dividends that are hypothetically being reinvested in this scenario. So that's $40,000 of tax-free growth now in this scenario compared to about $32,000 before. So what is that? $40,000, that's an $8,000 difference between an optimized Roth allocation versus an unoptimized Roth allocation. So you just had created for yourself $8,000 of tax-free growth that you can use right now or in the future. And if that keeps compounding over time, you build up that more and more and more. That's another example of why asset location is important. It doesn't necessarily always help you this year in terms of lowering your taxes, but it can, as I just showed here in the taxable account. But also it's going to help you in future taxes in terms of building a larger tax-free asset for yourself or your spouse or your heirs, and you're going to have more tax-free income to play with if you'd like to in the future. Now let's focus on the tax-deferred side here and show you some of the benefits of doing it this way as well. So now instead of a 60/40 portfolio, we have 0% stock, then we have 100% in the bond side of things. So again, 500,000, 4% of that amount is going to be $20,000 of interest on the bonds that are in that account. So instead of $32,000 across the board here, like we had last time, now our total balance is only $520 after 1 year. And again, you're not paying any taxes on the interest in this scenario because that is a tax sheltered account. But highlighting what I mentioned before, if we continue to grow this account at a lower clip or a lower rate over time, your RMDs will not be as large in the future. So it's a $12,000 difference in growth between an optimized or an unoptimized portfolio. Yes, you grew that specific account overall at a lower rate, but you're going to pay less in taxes here on the optimized portfolio, which means a total net after-tax gain is going to be greater in this particular year simply by doing this. So if you start compounding this and actually do the math on this over time and say, I'm going to grow my tax-deferred account at a lower rate, I'm going to minimize my taxes in my brokerage account every single year to make sure my Roth is set up for long-term growth at a higher rate. If you do all of that, you do it over a period of time, you're going to see a huge difference. And this is why retirees need to focus on this, because an unoptimized portfolio or just a blanket pro rata distribution of your assets across all of your accounts in an even manner or capacity is not going to be optimal long-term. So let me know your thoughts down in the comments below. I'm curious what your take is on this, or if you have an experience with this, or if you're already doing this in your portfolio, let me know, and I look forward to seeing you in the next video.